Just yesterday, Microsoft, the undisputed titan of the tech world, dropped an earnings report that looked on paper like an absolute grand slam. Let's look at the numbers because they are staggering. Total revenue hit $81.3 billion against the $80.2 billion estimated. That's a 17% jump year over year. Adjusted EPS came in at $4.14, crushing the $3.93 estimate. Even Azure cloud growth, the heart of the AI story, hit 39%. You're seeing it right. A double beat, revenue up, profits up, and AI-driven growth accelerating. But then something terrifying happened. The moment the after-hours market opened, the screen turned a violent, deep red. Microsoft suffered its worst bloodbath in 5 years, with the stock tanking from $481 to nearly $420. In a single trading session, over $350 billion in market cap was erased. Poof, gone. That is more than the entire value of Disney or Netflix, vanished in hours. Why did a double beat trigger a massive panic sell-off? Is the AI hype cycle finally dead? Or is there a skeleton in Microsoft's closet that the headlines are ignoring? Today, we're tearing down the 3 landmines hidden in this report. We've spent all night digging through the earnings call intel to tell you exactly when this power versus chips crisis will hit its turning point. Here's where things get genuinely weird, and this is the part the mainstream media is missing. During the conference call, Microsoft CFO Amy Hood revealed a bombshell. Out of their staggering $625 billion in remaining performance obligations, RPO, that's basically their massive backlog of future contracted work. Nearly half, about 45%, comes from just one single client, OpenAI. Stop and think about that. Microsoft is essentially acting as the landlord, the power company, and the bank for OpenAI. Is this a match made in heaven, or is Microsoft dangerously over-leveraged to a single startup that is burning cash at an unsustainable rate? If OpenAI stumbles, does the whole Microsoft AI house of cards come tumbling down? But more importantly, what if I told you Microsoft's biggest problem isn't a lack of demand, but a fundamental lack of physical supply? If they have the orders but literally can't find the electricity to run the servers, is this stock dip a warning sign of a dead end? Or is it a rare generational discount? Stick around until the end because I'm giving you the exact entry prices and the specific stop-loss levels for what might be the highest conviction buying opportunity of 2026. Why are institutional investors running for the hills? Look at the capital expenditure, $37.5 billion. That is what Microsoft spent in just 3 months on data centers and hardware. That is up 66% year over year. Wall Street is terrified. They are asking, you're burning tens of billions of dollars, but your cloud growth is actually slowing down slightly from 40% to 39%. This ROI gap is creating a narrative that Microsoft is sinking into a bottomless money pit with no clear exit strategy. But they are wrong, and here is why. If you only focus on the Capex, you are missing the most important technological pivot of the decade. On January 26th, Microsoft quietly deployed its secret weapon, the Maia 200 chip. This isn't just another chip. It's custom 3nm silicon designed to break the dependency on Nvidia. It delivers 3x the inference performance of the previous generation. Why does this change everything? Because we are in a power war. In 2026, chips are easy to find, but electricity is impossible to get. The Maia 200 is 30% more energy efficient than anything else on the market. This means Microsoft doesn't need to wait 5 years for new power plants to be built. They can squeeze 3x the AI capacity out of the existing power grid right now. While Microsoft fights for every megawatt, who is actually collecting the checks? You need to watch 2 specific picks and shovels plays. First, Constellation Energy, CEG. They are the ones restarting the 3 Mile Island nuclear plant exclusively for Microsoft. While that power won't hit the grid until 2027, Microsoft has already signed a 20-year contract. Then there is Vertiv, VRT. The Maia 200 chips run incredibly hot. Traditional fans and air conditioning simply won't cut it anymore. As Microsoft scales these chips, they are forced to buy Vertiv's high-end liquid cooling systems. So let's bring it back to your portfolio. Is this a buy? This crash is essentially a panic-driven valuation reset. Microsoft's PE ratio was getting a bit frothy. Now it's back down to around 30x, which is its historical sweet spot for long-term investors. Here are the 3 levels I am personally watching for my own portfolio. Level 1, the dip, $478. This is the 200-day moving average and a massive psychological support level. Level 2, the steal, $3.95. If the broader market goes into a full irrational panic and fills the old price gap, this is where you back up the truck. The exit, stop loss, $343. If we break below this level, the AI growth narrative is fundamentally broken. Bottom line, this $350 billion drop isn't about Microsoft failing as a company, it's about short-term traders losing their patience. Our team at Wall Street Radar spent days digging through these SEC filings and call transcripts to bring you this analysis for free. All we ask is that if this breakdown helped you make sense of the chaos, please hit the like button. If we can hit 50 likes on this video, I'm going to drop a deep dive special next week on the AI Power Grid. I'm Ryan, and I'll see you in the next one.